So yeah, as Steph said, my name's Jess. I'm the manager of the Foreign Exchange Dealing and Analysis team at the RBA. I've been at the bank for just over 11 years now and have spent the vast majority of my time in International Department, which sits within our financial markets group. And a substantial portion of my time within that group has been spent in our dealing rooms, both here in Sydney and also over in London. So this is a topic that I've spent a lot of time around. The Australian dollar is extremely important to us as a small open economy, and so I'm really looking forward to presenting to you on this topic today. When I was first asked to present on exchange rates, I was thinking I might struggle to fill this time slot. But as I worked through it and I saw the syllabus that you guys have to teach your students over the course of the year, I started having the complete opposite problem. I do think the nice thing about exchange rates is that they aren't an abstract concept to most of us. They're generally easier to grasp than some other economic concepts that are out there. We've been exposed to them in our everyday lives through just our everyday activities, really, purchasing products online or going on an overseas holiday. These concepts I do find are much more easily applied to our everyday life. But by the time you leave here today, hopefully you'll have a better understanding of exchange rates than when you walked in, and you can pass some of that knowledge on to your students. So just a quick summary of what this presentation is going to cover. I'm first going to step through the different types of exchange rates, before moving on to the different types of exchange rate regimes, including where Australia sits within that categorisation. I'll then move on to what drives movements in the Australian dollar, before finishing with why we care about exchange rates from a monetary policy perspective. And as Steph said, we'll conclude with a Q&A at the end. So starting with the basics, what are exchange rates? Well, an exchange rate, simply put, is the value of a currency expressed in terms of another currency. They are a relative price. They tell you how much of your currency is needed to buy another currency. However, there are several different ways that an exchange rate can be expressed. The ones that people are probably most familiar with are bilateral exchange rates. These are rates that you see in everyday life, on the news, at the airport, and so on. They tend to be quoted against the US dollar. So, for example, the Aussie US dollar rate, which is on the chart here. And what this is the amount of US dollars that you will receive for one Australian dollar. At the moment, one Aussie dollar will get you about 67 US cents. If the Aussie dollar was to appreciate, you'll be able to buy more US dollars. So one Aussie dollar will get you 70 US cents. Now, although the Aussie US dollar rate is extremely important, it only actually tells us a part of the story. Which brings me to the trade weighted index, or what we commonly refer to as the TWI. The TWI measures the value of a currency with respect to a basket of currencies, or a number of currencies at one time. This basket of foreign currencies reflects a country's major trading partners, and the weights that are assigned to them reflect the share of trade that the home country conducts with them. So the TWI tends to give us a broader measure of trends in a currency, as it shows whether it's appreciating or depreciating relative to its key trading partners. And because it aggregates movements against a wide range of currencies, and some of these moves are going to be offsetting, we tend to see that the TWI exhibits less volatility than what we see in bilateral exchange rates. So in Australia, about 30% of our TWI is accounted for by the Chinese renminbi, followed by the yen at around 13%, and the euro at about 9%. So as you can see, if we are only looking at the Aussie dollar against the US dollar, it means that we're missing out on the value of the Aussie against some of the countries that are most important to Australia's economy for trade purposes. The final variation that I wanted to touch on is the real effective exchange rate. And beyond it being a complete mouthful to say, what it is an exchange rate where we take the nominal exchange rate, such as the bilaterals that I just discussed, and we adjust it by relative price levels across countries. What this gives us is a better measure of trade competitiveness, as it better compares the true cost of Australian and foreign produced goods and services and tells you how much purchasing power your currency has. So with these different types of measures in mind, there's a few broad trends to point out in this chart. The exchange rate appreciated for most of the decade from the early 2000s to around 2013. And this largely reflected the effects of the mining boom. Since then, it's depreciated quite considerably as commodity prices have fallen and monetary policy has been eased here and around the world. I will speak to some of these driving forces a little bit later on in more detail. So in addition to the types of exchange rates, there's also a number of exchange rate regimes that a country might choose to adhere to. And regimes can be thought of as operating on a spectrum with varying degrees of flexibility. And I'll sort of talk to the broad two categories within that spectrum. So at one end of the spectrum is a fixed or a pegged exchange rate. In this regime, the monetary authority ties its currency to another currency or group of currencies. It might be pegged at a target level or allowed to vary within quite a tight range. However, it's almost impossible that this peg can be maintained naturally. To keep the exchange rate close to its target, the monetary authority needs to intervene in the FX market by buying and selling currency. And in order to do that, they need to hold substantial foreign currency reserves. They also need to set their policy rate at a very similar level to the economy that they tie their currency to. And this is so that capital flows stemming from overseas don't push the currency away from the target level. One of the major disadvantages of a pegged exchange rate is that the currency no longer acts as what we refer to as an automatic stabilizer. With the currency set at a given level and minimal ability to shift interest rates, the monetary authority can find itself in a position where it has very little control over inflationary pressures if they arise. So a fairly sensible question at this point might be, why would you choose to have a pegged currency given the intervention requirements and the lack of policy setting autonomy? The main benefit is that it can be used to keep your exports cheap and competitive in a global setting. It also gives you certainty around the value of your currency, and as a result, you tend to see a lot less volatility in your FX market. So an example of this is the Danish kroner. In Denmark, they peg their currency so that €1 is equal to 7.46 kroner, but it's allowed to fluctuate in a very tight band around that target level. At the other end of the spectrum is a floating or a flexible exchange rate regime. And under this regime, the country's currency value is determined by the forces of market supply and demand. The central bank really only intervenes in times of notable market stress or dysfunction. So this is the type of exchange rate that's employed by most of the world's major advanced economies. And what it means is that exchange rates are determined by things like interest rate differentials and trade, the global outlook, news, events, speculation, things like that. But again, I'm going to touch on these elements a little bit later in the presentation. So while the exchange rate is much more susceptible to large swings in valuation under a floating regime, there's several really important benefits. The first is that monetary policy can be set independently and it can respond to domestic economic shocks. A floating exchange rate also allows the economy to adjust to large external shocks to the Australian economy without threatening our macroeconomic stability. The last one that I'll touch on today is that there's also no need to defend the currency at a given level, and so less foreign currency reserves are required for that purpose alone. So from that discussion, maybe it seems obvious as to why Australia would want to adhere to a floating exchange rate regime, but it hasn't always been that way. Australia actually only adopted a floating exchange rate in 1983, and that was after alternative regimes, including pegs to gold, the pound, the US dollar, and the TWI, and so on, all proved untenable. Australia's developing financial system and the increase in international capital flows associated with that made maintaining a pegged exchange rate really difficult, alongside also trying to control domestic economic conditions. Today, the Aussie-US dollar is one of the most highly traded currency pairs in the world, and so we've come a really long way over the past couple of decades. Moving to a floating exchange rate regime doesn't mean that we can no longer intervene. It just means that the bar for intervention is higher. It's also actually really important to note that at the RBA, we transact in the foreign exchange market every single day, often to do business on behalf of the Australian government. But these transactions are conducted in such a way to not move market pricing or disrupt conditions. And that in itself is the key difference. When you're intervening in the foreign exchange market, you are doing so to influence market conditions. It's also really important to note here that affecting the exchange rate isn't a primary function of the bank's monetary policy. So after the Aussie dollar was floated in the early 80s, interventions were small and frequent. And the aim here was to smooth out volatility in the market in order to help participants manage their positions in, at the time, what was a relatively new market. But as this market evolved, market participants became more sophisticated and liquidity improved, the RBA could cease intervening for smoothing and testing purposes. And that brings me to the next reason that we used to intervene, and we call this reason overshooting. If the Australian dollar moved too quickly and was judged to have overshot the level implied by economic fundamentals, the RBA might have chosen to intervene. This was aimed at realigning the currency with where fundamental drivers suggest it should have been. And what this did was result in less frequent but typically larger and more one-sided transactions in the market. This intervention also helped send the market a signal about the RBA's view on the exchange rate and whether we thought it was severely under or overvalued. So this type of intervention was seen during the early 1990s, but the bar for conducting large-scale interventions soon became higher again. The main focus of intervention then shifted to episodes that could be characterised by significant market disorder. And what this means is instances where market functioning is impaired to such a degree that it becomes obvious that there's excessive volatility. The main example of this was during the global financial crisis when the Aussie dollar plummeted, and you can see that in the chart around 2008. At this point, liquidity in the market completely dried up. The RBA bought Aussie dollars to address severe market dysfunction and minimise disruptive price adjustments. And during this episode, we weren't actually targeting a particular level of the currency, we were just trying to improve market conditions. And we actually haven't intervened in the market since 2008. So I've mentioned a couple of times now that the exchange rate can move in line with or out of line with economic fundamentals. So a natural question is, well, what are the fundamental drivers of a flexible Australian dollar? Over the medium to long run, interest rate differentials and the capital flows that result from them, as well as the terms of trade, determine the value of the Australian dollar. So interest rate differentials, which are shown in the purple line up on this chart, are the difference between interest rates in Australia and those overseas. The terms of trade, which are in the blue line, is the ratio of export prices to import prices. Both of these variables tell us about the expected demand for Australian dollars, and both of them are positively correlated with the Australian dollar. And so I'll spend a little bit more time talking to both of these drivers. So what's actually important is how interest rates in Australia change relative to interest rates overseas. If interest rates in Australia fall relative to those overseas, then the returns that investors receive on Australian dollar assets become far less attractive, which creates less demand for Australian dollars and should put downwards pressure on the currency, all else equal. But if interest rates in Australia fall, and so do interest rates in other economies, then the difference between interest rates here and there are actually little changed. And in this situation, there's actually little incentive for investors to move their money because there's costs associated with doing that. So as a result, we probably wouldn't expect to see too much impact on the exchange rate. So the chart on the left here shows the Australian policy rate against that of the US, Euro area and Japan, which we commonly refer to as the G3. And the chart on the right shows interest rate differentials, so the difference between interest rates in Australia and those other three economies. One of the key trends in this chart is the fall in policy rates straight after the global financial crisis in 2007 and 2008. And you can see the policy rates basically went to zero in these really big economies, while in Australia they certainly declined, but they remained well above zero. The higher rates in Australia were related to the mining boom kind of cushioning our economy a little bit, but also just because we didn't see the same type of financial system stresses that were seen in the US and other big economies. You can also see that monetary policy in Australia was then tightened before being eased in the years that followed, and the policy rate went to near zero. And this flowed through to a decline in other interest rates in the economy, including government bond yields. All of this happened while rates in those other major economies remained at or around zero. So what did this do to the Australian dollar? Well, essentially, Australian interest rates went from being almost 3 percentage points higher than those overseas to being around similar levels as we entered an era of very low inflation. This decline or narrowing in interest rate differentials was the main driver behind the depreciation of the Australian dollar after its peak in 2013. We then entered the pandemic, which I'm sure nobody has forgotten about yet, where central banks initially eased policy before having to tighten in the years that followed amid a sharp rise in inflationary pressures. That's all to say that there's been a very coordinated policy response from central banks around the world, which has actually left interest rate differentials little changed since around 2020. This helps to explain why the Australian dollar has been so stable in recent years. So moving on to the terms of trade. Commodities account for a really large share of Australia's exports, and so changes in commodity prices flow through to changes in Australia's terms of trade. If the terms of trade increase, we can purchase more imports for selling the exact same basket of exports, which reflects an improvement in national income and also in our purchasing power. Commodity prices and the terms of trade can also affect the Australian economy through investment. So when commodity prices increase, exporters might decide to invest more in Australia in order to expand their productive capacity. And they would be doing so in order to take advantage of higher export prices and make a larger profit. This increased investment tends to come from money flowing into Australia, which supports demand for the Australian dollar and can lead to an appreciation. And indeed, this is what we saw happen throughout the mining boom. So this graph shows some estimates of the RBA's forward-looking model of the Australian dollar. The model estimates, which are in the red line on the chart, are based on those two fundamental drivers that I just discussed. So the model uses forecasts of the terms of trade, and it also uses interest rate differentials. And you can see that for the most part, it actually does a pretty decent job of capturing broader trends in the observed level of the exchange rate, which is in the blue line. On top of these longer term drivers, we also have short term drivers, which can tell us about what's driving the Aussie dollar on more of a high frequency basis. So these short term drivers actually tend to close the gap between that red and blue line even more. The Australian dollar tends to track movements in some other financial assets and is very sensitive to what we call risk sentiment. And what I mean by that is how positive or safe investors feel about exposing themselves to riskier assets. We tend to find that positive risk sentiment is associated with a stronger Australian dollar. So, when people are feeling positive, they'll have higher demand for Aussie dollars. It's also positively correlated with global equity prices. And so as a result, we tend to see that the Aussie dollar and global equities move together. On top of that, investors might also speculate about future movements in the exchange rate for a range of reasons, and so buy and sell the currency, to make a profit. And all of these types of trades will influence the direction of the currency. So I mentioned that the exchange rate is an important tool in allowing the economy to absorb shocks and news, and I want to round out this presentation by talking about how the exchange rate actually affects the economy. I think if you spoke to most people on the street, they would probably suggest that a rising Aussie dollar is better than a falling Aussie dollar. And this might be true in the narrow sense of the everyday consumer. It means your money's worth more overseas. I can buy more things, and that's great. But what this fails to do is take into consideration other sectors of the economy, like exporters or domestic tourism companies, and what that might mean for broader economic outcomes. So we tend to think about the exchange rate affecting economic activity and inflation in terms of direct and indirect effects. When the exchange rate moves, there is a direct effect on the prices of goods and services produced in Australia relative to the rest of the world. An appreciation of the Australian dollar means that Australian produced goods and services become more expensive than those produced overseas for people living offshore. And the opposite is true for a depreciation. The indirect effects then follow on from these direct effects. Changes in relative prices between Australian and overseas produced goods and services influence domestic production and consumption decisions. So for the purpose of this presentation, let's just consider a depreciation of the Australian dollar. A depreciation makes Australian products cheaper to people living overseas. This causes international demand for Australian goods and services to increase, since nobody wants to pay more for the same quantity and quality of goods. This higher demand leads to an increase in the quantity of Australian exports. At the same time, domestic-based consumers will also demand more products from Australia, since their money is now worth less overseas. This leads to a simultaneous decrease in the quantity of Australian imports. Firms in Australia need to increase their productive capacity to meet this heightened demand. This usually transpires by hiring more workers, which tends to put downwards pressure on the unemployment rate. A depreciation of the exchange rate then can affect inflation in a couple of ways. Firstly, when consumers or firms have to pay more for the same quality and quantity of imported goods as a result of a weaker exchange rate, inflation will increase. Secondly, the increase in aggregate demand and employment costs, partly via higher wage bills, increases the scope for firms to actually raise their prices and pass these on to the final consumer. This should also contribute to higher inflation. However, this process is far from immediate. And what that reflects is that customers actually have quite a lot of power in the market. They can easily substitute towards other products. The other thing is that, as I'm sure you're all aware, the exchange rate is constantly moving, and it's completely unrealistic to expect firms to be revising their prices multiple times a day. Work that we've done actually suggests that these effects can take place anywhere up to a few years after the change in the exchange rate. The other perspective that we should consider is the way that the exchange rate can assist the RBA in meeting its monetary policy objectives. And again, I'll illustrate this through an example. Strength in commodity prices from the early 2000s through to around 2013 saw the Australian dollar rally or appreciate. For some of this period, interest rates were also increasing to contain domestic inflationary pressures. So without the simultaneous rise in the currency, it's very possible that interest rates might have had to rise further. And this is because the Australian dollar strength helped to divert spending overseas rather than domestically. The final element that I want to touch on is how the exchange rate affects the balance of payments. And I appreciate that this is a huge topic, but we'll try to give a high-level summary. And again, I'm going to try and explain this through the perspective of an Australian dollar depreciation. When the exchange rate depreciates, our imports become more expensive relative to exports, which decreases the value of our net exports and reduces the value of the current account. This is the immediate and the direct effect. Over a slightly longer horizon, import and export volumes will adjust to those changes in prices. An Australian dollar depreciation will also increase the foreign debt servicing costs of Australians, since more Australian dollars will need to be converted into foreign currency to make payment. On the other hand, an Australian dollar depreciation will actually increase the income that Australian residents receive on their foreign currency asset holdings, as the return on those assets are now larger when you convert them back into Australian dollars. The size of the account will increase or decrease depending on which of these effects is larger, causing the net income deficit to rise or fall. We also have valuation effects to consider, and just a word of warning, these sound much more complicated than they actually are. Valuation effects are simply changes in prices that are due to interest rates or the exchange rate, rather than due to a change in the underlying price of the good or service itself. Valuation effects will also occur as a result of a depreciation because it increases the value in Australian dollar terms of foreign currency denominated assets and liabilities. As I said, this is really just skimming the surface on the balance of payments, but hopefully it gives you a high-level overview of the influence that the exchange rate has on all elements of the economy. That's quite a lot of content crammed into one presentation and a lot to remember, so congratulations if you've made it this far. But hopefully it does provide you with a bit more colour on the world of foreign exchange markets and why we care so much about them at the RBA. I'll also take the opportunity to direct you to some resources that are available on our website. Staff in Steph's team and those that came before her have put together some really useful explainer documents and videos that run through various economic concepts. They're super thorough and we encourage you to use them as much as you like in the classroom.